Hi, welcome to PlanStrongerTV. I'm your host, David Holland. On today's program, we're going to talk about government debt. Does it matter? Does it affect you? Do you care? Leo Haviland, market consultant, is my guest today, and we're going to talk about the economics of the situation. We're going to dig in right now. Welcome back. I was worried for a minute when I said the word economics and debt that you might not rejoin me. So let's dig into the program. And before I do, let me say this. This is not going to be a political conversation. If you want politics, there's plenty of other places to get that. What I want to talk about is the impact that government debt has on you and me. So how does it affect us? Well, let's start with recognizing that there's some $20 trillion outstanding that our government owes to investors, foreign and domestic. So how does that affect us? Well, that number appears to continue to be rising. Unless the government is able to take in more tax revenue than it spends, that number is going to continue to increase. Recently, it's been going up by about $500 billion, $500 billion a year. Now, that translates to an impact on us as individuals. You say, well, how is that, David? Well, when the debt increases, that means that ultimately, somehow, some way, it has to be repaid. And that usually means, you know what, taxes, more taxes in the future. So there is an impact of our government spending more than it takes in on you and I. Now, the other part of it is that as the debt increases, there, of course, may be less demand or not enough demand to keep up with how much the government needs to issue. And that translates to potentially higher rates that the government has to pay to get the money to run the government. That then affects not only the potential to have to pay more in the future again with taxes, but also impacts other types of loans. So we're going to dig into this. It's a heavy subject, but I think you'll find it very interesting and very relevant. So we're going to dig into this with our guest, Leo Haviland. Stay right there. I'm very glad to be joined by Leo Haviland today to talk about government debt and how it affects all of us. So let me properly introduce and welcome Leo. Leo, welcome to the program.
David, thank you very much. It's an honor to be on your show.
Excellent. Glad you're with us. So the introduction, Leo, first let me say, Leo, you're the person I go to when I want to understand more about some of the macroeconomics of how our economy and our country function, especially when it comes to debt and currency. So I'm really glad you can be with us. Leo is an economist and a business consultant, has worked on Wall Street, Goldman Sachs, and many other Wall Street institutions, does a lot of consulting work and looks at things from a macroeconomic standpoint, which I don't always have the luxury of doing, Leo, so I appreciate your perspective. University of Chicago, all right, and Cornell Law School.
That too.
Okay, and 3 decades.
That's a long time.
That's a long time. Well, we appreciate your expertise. So let's dive into this very important subject, government debt. You know, I think for a lot of Americans, they see maybe a TV commercial about it. Oh, our debt is this much now. And as you know, it continues to increase. How does that debt really affect everyday Americans? That's really what I want to get to with you. So let's start with the debt, you know, 20 trillion. I mean, I have a hard time getting $1 trillion in my mind. I can handle $1 billion, but $1 trillion. So these numbers are really astronomical.
Yes, they're huge. And an important element in the size of the debt is because we're all citizens, this is our debt. And you can divide it by the number of citizens, the number of people in the country, but we all have a substantial obligation, and that needs to be underlined.
All right.
And it ties into, as you indicate, David, other marketplaces, stocks, other areas of the interest rate world, like mortgages.
Okay.
Commodities, the dollar. And all those things matter to us as citizens and to us as business persons and to us who are doing individual financial planning.
Okay, well, we'll connect the dots for everybody on that, because I think for a lot of people, they hear that and they go, Leo, okay, I hear you, but I don't understand how we connect that to my personal finances. So we'll take maybe a step at a time. As that debt goes up, and it does concern people, and I want people to know at home that we're not saying, let's pull the fire alarm and do something rash and take every nickel you have and put it in gold or go buy survivalist gear and move to the mountains. We're not saying that. But what we are saying is it does need to be considered. So let's connect the dots. So as our debt increases as a country, and I'm not going to do the math of how much we all individually owe in effect by this total debt, but when we look at that, that affects things like, we'll start with mortgage rates. The translation is that as the debt goes up, there may be a need for rates to rise in order to induce investors to buy the debt.
That's correct.
So with that, that means that the rate might be higher, and then, okay, that means there's going to be more taxes to be paid later, but how that affects mortgage rates?
It does, because mortgages and other interest rates typically have their relationship or yields priced in relation to what's happening in the U.S. government note and bond marketplaces. So as U.S. rates, and for that matter, government rates abroad shift, that affects what happens in our mortgages.
Okay, so if to put it succinctly, if mortgage rates are linked to Treasury and U.S. debt, and our government has to pay a higher rate, not only are we going to end up paying more in taxes ultimately to pay the extra interest, but we are also going to pay more in mortgage interest on our mortgages. So we almost pay twice, plus the potential impact on the dollar.
That's true.
That's not good. Okay, so we won't get into the political aspects, as I promised, but the reality is that these things all trickle through. Now, there's another thing that I have to ask you, Leo, and I know that the viewing audience would want me to talk to you about this, and that is this whole thing about the debt. Who owns it? Does it really matter who owns our debt? There's 20-some trillion. Does it matter if a foreign government or investors or whoever is the one that owns that debt and is receiving the payment and the interest?
It does matter, David. Of the debt total that you mentioned, one owner is the Federal Reserve, who has about $2.5 trillion.
Okay.
So after we look at the Federal Reserve, two categories come up. One are domestic Americans,
okay,
persons on the street and American institutions, and the others are foreigners. And the foreigners break down into both the general public, and then it's the official institutions like central banks and so forth.
Okay.
And currently, the central banks overseas or other official institutions own perhaps $4 trillion out of the $6 trillion that are held by foreigners in general.
Okay.
So that's over 40%, the $6 trillion of the $14 trillion in public debt out there. So it does matter who owns it and what they decide to do with it.
Well, and the one that comes to mind, which is of course almost always in the news, is China. And so China owns or controls, say, $1.5 trillion. Okay, so the worry that people have is that China would call up and say, hey, you owe us this money, we want it back now, almost like they're coming to your door demanding payment. Can they really do that?
Well, in a free marketplace, if China, and most of the Chinese debt is probably held officially,
right,
sold all the treasury bills, notes, and bonds they had, that would have a dramatic effect on U.S. and, for that matter, interest rates. They would spike.
Okay, so they can't demand the payment, but they can sell the debt that they own, the loans that they're holding on our government debt. They can sell it in the free marketplace, and by putting that much money, that much debt for sale, if you will, that would cause rates to rise in general pretty quickly?
Right. Well, much will depend on whether there are happy and willing other buyers of those
that's the key.
Sales.
Yeah.
And it's unlikely that China would sell the whole trillion or even a large part of it all at once. However, they might reduce their rate of buying of the debt.
Good point.
And if they were either net sellers or reduce net buyers, that would have an effect on U.S. interest rates, all else equal, because someone has to buy our debt, and as you point out, the U.S. government, which is all of us, is issuing more of it.
Right. Well, and so we've got roughly, and I know this number will vary year to year, but we've got roughly $500 billion each year that we've got to fill the gap between what we take in taxes and what we spend. And so we have to have somebody to buy that debt. So if so how does the perception about our having, as a country, our financial house in order, how does that affect? I mean, could at some point the foreign or domestic buyer say, you know what, you've got a lot of debt, we're thinking we're going to want more interest. You're not such a sweetheart safe place as we used to think you were.
Various factors intertwine to guide individuals and countries' decisions on that. One consideration would be the assessment of the quality of the country's leadership and how divided the country is.
Okay.
The more challenging the political situation here is, the less inclined both domestic and especially foreigners might be to hold American securities.
Okay.
Another consideration would be if particularly the foreigners felt that the dollar was likely to start depreciating after having gone up on balance for most of the past 6 years. That also could cause interest rates to go up because they'd have to be paid a premium to want to own the debt.
Yeah, so tumult, uncertainty, disruption, political transitions, all of those things weigh on the potential buyers of our debt.
Yes.
So when we have this political divide, which I think you're kind of referred to, Leo, and our country, you know, at different times is more politically divided than others. Is that a fair statement?
You're right.
So with that doesn't necessarily send the best, I don't know, stability, perception or message to people that might buy our debt. But the thing that I guess that we have as maybe a little bit of a security or a little bit of an offset that I would love for you to comment on, and that's the relative safety. The relative safety of our debt versus, say, for example, a Spain, or in the more extreme, a Greece, where we are, as a country, our debt still perceived to be kind of, quote unquote, the safest place in town?
Many would say it. Those who are more critical could say we may be the best of the worst.
Okay, best of the worst. The cup is half empty, the cup is half full. All right, so those are all things that as we sit back and we watch the politics and we watch all this unfold, this all does really impact us, both in terms of future taxation and in terms of the impact it has on our debt that we use. And you know, the thing that I've always found interesting is the impact on mortgages, which we talked about a minute ago. You know, if rates go up, for example, U.S. debt by, say, 1%, which you would agree is certainly possible, that translates to higher interest rates on mortgages, which translates to a higher payment or less of a value of a home you can buy for the same payment.
Right.
I mean, that affects all of us.
Right. And also, because in America in particular, consumers are indebted in ways outside of mortgages, whether it's auto loans or credit cards, that higher debt levels in the federal sector, if it's translated into higher interest rates elsewhere, affects Americans and others in their other debt situations. Another field to consider is because so many Americans own stocks, that sustained rising interest rates here likely could have a very damaging effect on stock market prices and perhaps inducing a bear market.
We don't want that. Do something about that, Leo. I don't want a bear market.
My prayers are not working in any dimension, David.
Okay. Well, with that reality, and I know I understand where you're coming from, because the interest rates, of course, can affect companies and how they finance their operations and the amount of expansion they will do, whether they'll build that new factory and create jobs here in America, or whether they might look at doing it overseas.
Right.
You know, there's a lot of things there, but also it affects their profitability, and the profitability of a company directly affects ultimately they call that the fundamentals, right?
Yes.
Ultimately affects the value of companies, which translates to the value of your 401k.
Absolutely.
All very intertwined. You must spend just days at a time thinking about how all this stuff intertwines.
When the game changes as it moves forward, so it is very challenging for all of us.
So what are some of the practical steps? You know, this is what everybody's waiting on us to say, Leo. Okay, here's what you do. Some of the practical steps, would you say, would include not only paying attention, of course, but being more diversified and looking at how these changes could affect your portfolios and your personal finances?
Diversification is excellent, particularly given such a complex and multipolar world where what's going on overseas is affecting us here. So being involved in a number of different marketplaces as an asset holder, whether it's mortgages, equities, some commodities, and paying attention to dollar trends all matter.
So a portfolio that may include some bonds, may include stocks. You might use mutual funds. You might decide to do some rental property. You might decide to hold, you mentioned some commodities and or precious metals. We haven't really gotten into the aspects here of that, and we'll probably need to cover that separately, but the dollar and the strengthening of that and how that affects all those things together. So much of this comes together. Is it fair to say that if we stay diversified, that we stand a good chance of, quote unquote, weathering the storm?
Well, diversification helps unless there's bear market trends in several of the
If everything goes down, right? That's what they call that, rearranging the chairs on the Titanic?
Well, that means calling for help or figuring, why didn't I get out?
Yeah. Well, and that's another point that a lot of times people will ask me about is, or they'll say, you know, can't we just take the money out when things go down? Can't we just shift to cash and then wait for it to start to go back up and push the money back in?
Well, there are those who frequently, at the right time and quite wisely, have said that cash is king. In the current environment where many Americans and others have earned an awful lot of money from the stock marketplace rally of the past few years, they should strongly consider levels at which they would sell out of a substantial amount of their portfolio, whether it's if prices went a bit higher or if they started going lower, because nothing grows to the sky.
That's true. There is no historical precedence, which everybody wants to look at what happened in the past, but there is no historical precedence for an unending bull market. They always come to an end, and corrections in bull markets are definitely a frequent occurrence in the past. That's fair to say.
Yes.
But you made a real key point that I want our viewers to really hold on to, Leo, and that is the cash is king. You should always hold cash, at least for part of your portfolio, no matter how good things look, right? And then the other thing is to think about those gains you've had and evaluate whether or not you want to take some money off the table.
You're right.
Yeah, I think that's
absolutely.
the key. Okay, good. So, Leo, thank you very much for being with us.
Thanks for having me on your show, David.
Pleasure.
It's a
Leo
pleasure.
Haviland, ladies and gentlemen.
Thank you.
Thank you. All right, it's time for viewer questions. All right, here we go. So this question is probably one of my top 10 favorites. The question comes from Lee in Palm Coast, Florida. And Lee writes to me and says, I recently read an article in a magazine that described an immediate annuity as a simple and relatively safe way of converting a portion of your savings into retirement income. Are they right? Is this a good way to get retirement income? And Lee's referring to the magazine in their putting this forth that the immediate annuity is a good choice as described. So I like this question a lot because it really hits several things, and I'll get to as many as I can. Number one, whenever you read any publication, magazine, newspaper, see something on television, hear something on the radio, you always have to consider the source before you draw any conclusions from what they're telling you to do. So, for example, with a magazine, as Lee is asking in his question, before you even read an article in a magazine, I invite you and recommend to you that you open the magazine up and flip through it and look at who all the advertisers are and get a general sense for the magazine's theme or even their integrity. Are they promoting certain things primarily, and are all of the articles written to kind of support their advertisers? Or are they very neutral and objective? And also, when you read something that promotes within the magazine or any of these other publications, something that promotes a particular product or service or way of investing, read the fine print. You may be surprised to learn that either the magazine or the organization that puts out the magazine benefits from your buying that product or hiring somebody to provide you that service. Imagine that. So, is an immediate annuity a good recommendation? As you've accustomed to hear from me, it depends. It just depends on your situation. I will say that immediate annuities used to be much more popular than they are today. A lot of other annuities have become more popular in recent years because of the evolution of product design by insurance companies, also interest rates. So today, and in recent years, immediate annuities represent probably less than 5% of all annuities that are done. The other 95% are other types. And I have found in my own personal financial planning practice that only a few times over the years have I recommended the immediate annuity for a particular set of situation or circumstances. But I found more often that other types of annuities are appropriate for the clientele that I've worked with. So when you are looking at a recommendation and you're evaluating whether it makes sense for you or not, you have to think about whether or not you're going to fit that particular circumstance where that product may make sense. And please ask for a second opinion. Check around. Don't just go with one source. But one more thing I'll tell you on this, which is really important. With any product, an immediate annuity or any other annuity is a great example of that. If you go out on the internet or you look at different sources, some are going to have a positive view, some may have a negative view. There's going to be different thoughts out there or different commentary. So always remember that there's going to be advantages and disadvantages with any particular product, and there are going to be people that think differently about them. So that's the viewer question for today. I'm glad we could talk about it. One more thing before you go. Quick personal story. Had an opportunity to go out and do some horseback riding on a family vacation, and it was pretty neat out on this beautiful day, riding horses with the family. And I got distracted, I'll be honest with you, and I found myself off to the side, my horse munching on grass like they tell you not to. Anyway, the guide yells out, "Hey, get out of there, rattlesnakes and badger holes and sharp rocks for you and the horse." I got back on the trail, started talking to the guide, and he says, "What do you do back in the real world?" I said, "Well, I'm a financial planner." He goes, "Oh boy, me and my wife really got taken a few years ago. She had inherited about $300,000 in money from her family, and they had entrusted a guy to invest the money for them. And they ended up stealing the money from him. It was a big fraud. The guy went to jail, and the guy said, 'Good thing, because I'd have strangled him.' But I said, 'Well, what did you learn, or what do we take from this, or what can I tell other people about your story?' He said, 'Well, you know, how you were off to the side with a horse, off in the away from the beaten path's for a reason. It's safe. You're over there with the badgers and the holes in the ground, sharp rocks and rattlesnakes. Same thing with your money.' I'm like, I'm the financial guy, and you're telling me this is pretty cool. But it makes a great point. And I said, you know what? Billy was his name, Billy Diamond. I said, Billy, your story is spot on. He goes, I laid in bed for a year looking at the ceiling, wondering what I could have done differently. The best thing I could tell other people, and you tell them, David, and so I am, tell them to stay on the beaten path, check out who they're working with before they work with them, check around, get more than one opinion, and be very careful with your money. You know, roping and riding don't pay much. That money would have made a big difference in my life. So for other people, tell them to be careful. So I'm fulfilling my promise to Billy. You be careful with your money. Don't get taken advantage of. Check around. Double check. Be sure you're doing the right thing, and that'll help you plan stronger.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.